Welcome to The Explainer. Today, we're going to talk about something pretty serious, the connection between global conflict and, well, your wallet. So let's just jump right in with the big question, right? What would a new major war, say in Europe, actually do to your portfolio? We're going to look at what history can teach us about how to navigate these really uncertain times. All right, first things first. To figure out the potential impact on our money, we have to get the lay of the land. And right now, our sources are painting a picture of a world that's, well, it's pretty fragile. Analysts are keeping a close eye on a few key flashpoints. Obviously, there's the ongoing conflict in Ukraine. One source suggests it's rooted in long-standing disputes over NATO, but the immediate concern is that Russia's military is proving to be pretty formidable. Then you've got this other hotspot, Kaliningrad. That's a small piece of Russia completely surrounded by other countries. Lithuania's actions there have really sparked some serious threats from Moscow. All of this is creating a very, very tense situation. And it's not just geopolitical tension. Our sources point to some worrying signs in the financial markets themselves. See this number, 39? That's the Shiller PE ratio, a really famous way of measuring if the market is overvalued. Now, to put that into perspective for you, a reading over 32 has historically been a major red flag, popping up right before huge crashes like in 1929 and the dot-com bubble in 2000. So what's fueling this whole situation? Well, a huge part of it is money. Just look at Russia's military spending. It's skyrocketed to about $150 billion a year. That's triple what it was in 2022. They've basically turned their entire economy into a war economy. And then if we look at the US market, analysts are flagging another major risk, concentration. It's kind of crazy, but just 7 big tech stocks, you've probably heard of them, the Magnificent Seven. They make up almost half of the entire value of the S&P 500. And our sources warn that when so much value is in so few baskets, it can make the whole market incredibly shaky. Okay, so the stage is set. We've got geopolitical tension and some wobbly market fundamentals. So what's the first thing that happens if a new major conflict actually breaks out? Well, history gives us a pretty clear answer on this one. The market's first reaction, its gut reaction to the shock and chaos of war, is almost always a huge, fast, fear-driven sell-off. And it makes sense, right? Investors make money by predicting the future, by figuring out what companies are going to earn. But war just throws a giant fog over everything. It becomes impossible to know what's coming next. So the default reaction, as our sources point out, is to sell first and figure out the rest later. But here's where the story gets a lot more complicated. After that initial panic passes, something else starts to happen. It's not as simple as just war is bad for the economy. This is a really counterintuitive idea from our sources. War can actually act like a massive, short-term stimulus for an economy. Think about it. Governments suddenly start pouring unbelievable amounts of money into building tanks, buying supplies, and paying soldiers. I mean, just look at Russia again. We saw their budget tripled. And one report shows that this massive spending has pushed unemployment to a 30-year low. And because of wage inflation, it's actually boosted the standard of living for some people. In the short term. Of course, that's the key phrase right there, unsustainable. And what's the inevitable side effect of pumping all that cash into the economy? Yup, inflation. As one source puts it, war and inflation pretty much always go hand in hand. You've got way more money chasing a limited supply of goods and resources, and that just drives prices up for everyone. So we have the initial shock. Then we have this weird stimulus effect. But the long-term impact on a stock market? Well, that depends entirely on which side of the fight your economy is on. When you look back at past wars, our sources say it all boils down to one crucial question. Is your country's actual physical economy getting destroyed? If the war is fought somewhere else, your economy can actually benefit from all that government spending. But if the war comes home, investor confidence just evaporates. World War II is the classic case study. For the United States, the home front was totally untouched. And its stock market, believe it or not, generally went up during the war. Now, contrast that with Germany. Its cities and industries were flattened, and its stock market was pretty much wiped out, worth almost zero by the end. So, knowing all this, the historical patterns, the current risks, what are you supposed to do as an investor? Well, let's take a peek at how some of the smartest investors in the world are playing it right now. This tells you a lot. Our sources have noted that Warren Buffett, probably the most famous investor alive, is sitting on a huge pile of cash, almost 28% of his portfolio. That is the most cash he has ever held, way up from his usual 10%. And that kind of move suggests he's bracing for a downturn, keeping his powder dry to buy things when they get cheap. So based on observations like that, one source lays out a pretty clear defensive playbook. Step 1, diversify. Get away from those risky, super concentrated parts of the market we talked about. Next, consider allocating some money to a traditional safe haven like gold. And finally, just like Buffett, keep a good chunk of your portfolio in cash for both safety and for future opportunities. You know, the big takeaway from all this isn't about predicting the future. Nobody's got a crystal ball. It's about being prepared. The goal is to build a portfolio that's tough enough to handle whatever the world throws at it, so you can protect your wealth through all the chaos. Ultimately, understanding how all these pieces fit together, the geopolitics, the economics, it just helps us think more clearly about risk. And it leaves us with one last thing to really chew on. In a world that feels like it's always in conflict, what's the real price that we all pay for uncertainty?